Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
With me today is Krista Morgan. Krista is a general partner at Stage, a early-stage private equity firm based in Denver, Colorado. She's also the co-founder of Aelin.ai, an artificial intelligence platform helping small businesses prepare for loans. She's currently also a board member of Peak Beverage, and before she joined Stage, Krista was a founder and CEO of P2B Investor, a marketplace lender for lines of credit for businesses that can't get traditional bank financing. Krista holds a Bachelor of Arts in Economics and Political Science and a Diploma in Liberal Arts. Krista, welcome to the show.
Thank you for having me. It's great to be here.
Let us start with Stage. I just read it's an early stage private equity firm. What can I understand with early stage private equity?
Yeah, it's a made up name, so that's why it's not that common. We've coined the term because what we're doing is buying relatively early stage technology companies, so post Series A, Series B, like stage companies, and we're taking them off the venture path and actually running them with a private equity mindset. So more of a mindset of, profitable and moderate growth versus this, kind of hockey stick growth at all costs venture model.
Okay, interesting. So a Series A, Series B company, how much is your average deal size? So traditional private equity is like a couple hundreds, maybe dozens of millions to literal billions. What do you usually, what kind of a stake do you usually acquire in those companies?
So we usually acquire a controlling stake. So we are buying a majority interest in these companies, but usually there is a reason that they've received venture funding, but 50% of companies that receive an A round will never receive a B. So it's actually a pretty large number. And these companies are subscale and they can be acquired at really, less than 1 times revenue typically. So the actual amount that it takes to buy them is not huge. For the fund, this second fund, our average initial check size is 3 to 5 million, and then we reserve some follow-on capital, going up to 7-8 million at our max. So it's a relatively small dollar amount, but what we see is, significant potential for upside, because if you can buy a technology company at 1 times revenue and then get it back on a path of profitable growth, all of a sudden they can be turned at, 3, 5, 7 times revenue. And so the multiples can be, excellent from an investment standpoint.
That is interesting because I've spoke with a couple of private equity investors that do the typical, just out of the top, Wei Shan comes to mind, to bought an entire bank in Korea, right? Things like that. And I remember him telling me one thing that in their own financial modeling, he never allowed his team to do is to increase the multiple that you can sell it for, right? So he always said, if we make a deal, we cannot, fool ourselves a bit and just we're going to increase the multiple, right? That's how we're making our money back. Is it similar with you? But I think of your last answer, I think it's kind of different, right? Because it's all you do is try to get turn the multiple around.
When we buy a company at, call it 1 times revenue, it's absolutely worth more than that. And I say that because there's, investors, especially in the early stage, I don't want to accuse them of being lazy. They're not lazy, but they are. If you're an early stage investor, you're looking at so many deals that you have a filter, right? You're like, oh, this is a problem next. This is a problem next. And so you're not going to really dig into a company. So for example, we'll buy a company where they have too much debt. Right. So they've got too much debt to the amount of revenue that they've got. And a lot of investors are going to say, well, I don't want to get in the middle of this. I don't want to put new money in because the debt's there. It has the valuation that we buy them at has more to do with the situation that is happening versus the actual value of the company. And because we are willing to really roll up our sleeves and say, look, if you take away this debt and you take away the fact that, I don't know, COVID happened and they didn't grow for a year, if you can look past that, is there something here that really is valuable? And remember, we're deliberately buying companies that have received typically $20, $30 million of investment prior to us coming in. And so we're really saying, like, let's buy that money at a big discount. Let's see, where was that money invested? And often, so if there's been 20 million invested and we buy the company for $4 million, in our minds, right, there's value that's been created there that we can get. So while I would agree, I think in traditional private equity, you can't count on the multiples. From our perspective, our entry multiple is very good just because of circumstance and our willingness to really, look past a lot of things and believe. We're still early stage in that we have to believe that this company can get back to a place where it's going to be valued at a more traditional technology multiple. Now, I will say we're not looking for 10, 20 times revenue multiples, right? So those crazy tech valuations are not what we're saying. We're just saying, look, you take it from one, you grow it, by 50%, 100%, and now it's a 3 times multiple. That's a good return for us. This is not venture returns, right? We're not getting 50x our money, but our feeling is this is a strategy of singles and doubles. So we want, it's not about home runs. It's like, let's make sure we get 3 to 5x on every single investment, and then we'll be a very, strong performing fund.
I mean, it's kind of like a deep value strategy in the public markets, like that Charlie Munger, Warren Buffett. They're kind of like the cigarette butts that they are trying to find, and then they grow that. It's not 100-bagger, but it seems a kind of less risky approach than typical VC does, where they, not to put down any VCs, like I have a lot of VCs and I have the utmost respect for them, just like that. But there's like where they kind of do a bit of spray and pray, right? That's like not in the sense that blindly allocating money, but they have to have a lot, like some very good bets, because a lot of them go to zero just because they don't have the patience of the capital that where you say, okay, this thing is wrong. Okay, that's an out, because there's like 10 other companies waiting in line. So is it right to say that what you're doing is a bit like distressed venture capital?
Yes, that's exactly right. Yeah, because and there are not a lot of people doing it. Handful of funds. My partner Dan started Stage back in 2009, so he's been doing this for a long time. He has a good track record, which is also how we get our deal flow. A lot of our deal flow actually comes from the venture lenders. So as venture capital has exploded over the last 5 years, so too have all these lenders are saying, well, we're going to lend not to the fundamentals of the company, but to the strength of the cash on their balance sheet that they just got from these VCs. And so then is what happens if the VCs decide they're not going to keep investing? As a lender, you really don't have an asset unless someone is going to keep that company going and keep supporting the equity so that you can try to get your debt returned. So that's been how we've entered the market, is we're finding these companies that have a debt situation where the lender is really pushing for there to just be a deal. They're like, we don't care about valuations. We just want to make sure this company doesn't go out of business. And it's that pressure that is also what's driving the value in the strategy. Again, it's not, they're running out of cash. So the options are limited. And I went to this startup event because I was an entrepreneur for so long. And then when my startup didn't make it, I pulled back, right? Because I was like, oh, I don't want to go see anyone. And then when I went out again, my first startup event, I was talking to this entrepreneur about what I do, and he's like, so you're like the grim reaper of startups. And he didn't
Okay,
want
that's one way to put it. The other one, you're the savior of the startup, right? I mean, it's like go bust or turn it around.
that's what I said. I was really disappointed. Yeah. So, but it is. It's a unique strategy, and and a lot of when we're out fundraising on the fund side, the LPs are often like, but if the VCs don't want it, it must be bad. So why would you want it? That's probably the number one thing we have to be able to speak to is, why is this still a good investment? Even though it's not a unicorn, why can it still be a solid, investment for another fund?
Yeah, I mean, if you get 20 million of kind of product R&D, research, marketing, customer base for 4 million, well, it's maybe not, like it's not a 20 million because they have to 10 extra investment, and you have, as you said, it's not going to be a unicorn, but the company could easily be worth actually 20 million because that's maybe the worth of the R&D that's in, if it's the cash in, if the founders didn't just completely waste the money on parties and free drinks in the office, then something has to be done with that, right? So I mean, if we're looking at it, what the numbers you just told me, you buy a company, say for one-time revenue is 4 million. In a VC case, I mean, I've easily seen that valuations are done at 100 times revenue, right? Or 60, 80, 50, whatever, like huge amounts. And then they invested 20 million at 100 mil, like at 50 times revenue. In this case, that would be 25 times revenue. If you'd buy it for 1 times revenue, you can actually sell it for 4 times revenue. That's a ticket right there, but it's not a VC case, right? A VC needs one investment that they can then sell at 100 times revenue. So I think I get it. Like, this
Correct.
makes a
Yeah.
lot of sense.
Yeah, it's a different fund modeling approach, right? Like, just for the return profile is different, and that's what we say to LPs is you have to look at it on a case by case basis. And if you look at our track record, it's proven out, to work. So far, knock on wood, we're only at fund 2. But
let's go back to the single deals, because you said you're usually getting approached by lenders that give the company money based on their already good, like, equity base, because they just got investments and they burn through it. And the current investors, how are they dealing with you kind of offering them not even their money back, right? So they make basically like an 80% loss on their valuation or even on their money, right?
yeah, that's it. It's interesting. To your point, so no investor is happy. So let me just start there. No investor is like, oh, thankfully stage is here to, sort of wipe out our investment and recap everyone. However, a lot of investors, if you're a venture investor, and we see this a lot, one of the first companies we bought in Fund 2, they had a couple big VCs, and the VCs were supportive of the company, but they're like, look, we're out of fund. This just did not make the cut in this fund to get more money. But in the end, they still have to be on the board. They're still taking calls from the CEO because they're running out of cash. There's all of this mental energy that the company still takes up in your portfolio. So a lot of when we're working with VCs, we're saying, look, you're not getting your money back. You're going to get a ride, right? We're going to give you upside in the go forward business. We often structure. I mean, I love structuring deals. So like, I'm a bit of a nerd about it, but so they might get a junior preference. They might get, we've done trigger waterfalls where at a certain return profile, they can get more of their money back. So there's a lot of ways you can creatively say to someone, like, if this goes well, you can get your money back. But right now, all you want is to not deal with it anymore. And and you want the company to have a chance, right? And VCs, as a general rule, are very founder friendly. So if you can say to them, look, like, let's give this founder another shot, which is what we're doing. We're really saying to the founder, to give you a clean slate and try again with a different mindset, but let's try again. So, it's always a discussion, but by the time someone's coming to talk to us, they've often accepted that their investment is not going the way they thought it was going to go.
I mean, for everybody involved, it's either you go with stage or you go to zero, right? Because apparently nothing else is happening.
Well, there's very few options. That's right. Who's buying, even a $3 million tech company that's burning $4 million a year? Like, you really have to believe in that technology to take that, right? Like, it's a lot, and all the debt and the complexity. It just is. It's hard to justify doing a deal of that size as a strategic acquirer.
You said acquirer. So who is usually the buyer afterwards? Do you then give the company back maybe to VC investors again, or is it mostly always a strategic acquirer?
We tend to focus on strategic acquirers, or so we try to build relationships with other private equity firms and get into their roll-up strategy. So one of our investments is unlikely to be a platform investment, but we might say, look, do you want to roll this up? Because again, if we can give them a company that is growing, has had a bunch of R&D invested in it, so they have strong technology, but we can sell it to them at 3 or 4 times revenue, right? That's a much better deal. The way I think of it is, if we're a value buyer, we can also be a value seller and yet still be giving our LPs a great return. So, and ideally, what we're saying to them is, we're giving you a tech company that already has the mindset of, let's not just spend money on everything. Let's be more intentional about where our investment goes. And, we have our OpEx is under control. They're not getting, huge OpEx budgets. So those are really the 2 avenues that we look for, is strategic or another private equity roll-up strategy.
Okay, interesting. So now we kind of walked on a very high level through an entire deal, right? I would now like to dig a bit deeper into every stage. In the beginning, you quickly mentioned deal flow. Could you explain a bit more in depth how your deal flow process works? Do you collaborate with banks, with founders, with VCs? I would say, kind of like, who are the 80% of people that get you deals?
The 80% are really the venture banks, and then technology lenders. So if you look at Fund 1, I think, in fact, every single deal came from a lender of some kind. I ran a lending company for about 7 years, so I actually have a lot of relationships in the lending space, and I know what lenders care about. So it actually works. And then Dan had built relationships with lenders as well. So I would say that is the majority of deal flow. We do get direct. So we do get founders that will reach out to us directly. We also have some VCs that we've worked with in the past that will bring us deals. But the highest, call it quality and then conversion rate, come from lenders, because they have a company that they know needs a new home, and they know they're watching the process, and they know there are not a lot of options. And they trust us, right? They trust us to actually be able to, because there's no point in selling someone a company, even at a very cheap price, if you don't believe that they're actually going to be able to turn it around and return your debt. Otherwise, why do it? So that track record really helps get us a first look at deals. So we're able to see a lot, especially right now. I'll tell you, right now has been crazy. I can't Like I almost like there are deals that I'm just like, oh, I don't even have time to do an intro call right now because venture is pulling back. So it's just, it happens to be a sort of crazy time in the market.
This is definitely the one thing I have on my list to discuss with you. How the recent venture downturn has impacted your business, but let's park it for a second. I promise I'll come back to it, because one thing you said is like that you said earlier, you love structuring deals, and I think this is a good combination of this kind of deal structure. So a lender, do they also lose part of their investment sometimes, or are they usually getting out unharmed?
I would say they're usually they're not usually getting out at. If they're getting out, it's because they've said they'll take a discount. So one of the Fund One companies, they had, I think, a $1.8 million loan with a venture bank, and the bank, it was the deal closed on December 28th, and the bank ended up saying, like, we just want this off our books. We wrote them a check for $250,000 and they walked away. So that happens. Or more commonly is, we'll say it'll be a $5 million loan, and we'll say we'll give you $1 million upfront. We'll restructure maybe $2 million of debt, right? So you keep $2 million of senior debt, and then we're going to give you either a junior preference or a warrant or some kind of other instrument that's more upside only, versus, because our point to the lender is, look, a lot of the times we're seeing companies that have more debt than revenue, and it's just not healthy, right? Like, our point is, why do the turnaround if you're going to leave this company totally over leveraged, trying to service debt that they can't afford? So they do, I don't want to say they lose, because at the end of the day, we really focus on returning lenders their principal. It's just not all on day one. It's like they have to kind of ride with us to try to get out relatively whole.
So, but the debt is also restructured. So not only the cap table is restructured, but also the debt is restructured. So they might get some money back. They might have to take a haircut. But it's also not that the lender just keeps 100% of their loans intact as they are.
Rare. That would be rare. Yes, correct. That is not common.
Okay, I mean, it makes absolute sense. And I wonder, like, one point I kind of wanted to make earlier is, why are lenders, maybe just like my theory, are lenders more inclined to actually push for a sale and a restructuring? Because their key metrics is to keep default rates as low as possible. The key metric of a VC is to create as many unicorns as possible. And if a company or two, they go to zero, right, it's not their key metric. It's not what they are after. But a lender is like, if they have, my average default rate for the year's up, I was like, damn,
Correct. That is exactly right. I mean, we had one deal where the bank was so they were determined not to take a write down. So they had, I think, $5 million of debt. We did a $1 million pay down, and they said we must keep all $4 million of debt. And the company really couldn't afford $4 million of debt. So I said, fine, we'll leave it, but our interest rate has to be, I think, 3%. And so that way we would have paid 6 or 7% on 2 million. And my point is, I'll pay you 3% on 4 million. So again, my job in these situations in a restructuring is always, there are a lot of people at the table. You're trying to figure out who really needs what, and how do you come up with something that works for everyone. So there's I think it's part of what I really like about it. You have to get creative, because everyone's got to feel, you want everyone to feel at the end of the day that they're like, okay, like, I got what I needed out of this deal. I didn't get what I wanted, but I got what I really needed. And that's how you're able to actually get everything to the finish line. Otherwise it falls apart, right? If people have to take too much pain, a lot a lot of times there's almost an ego there. They just are like, I didn't really get what I needed, so why am I supporting this deal? I don't want to.
Yeah, I mean, if I don't know what is a good metaphor. If you get like 1 cent back, you might as well lose everything, right? So you don't even care about like the 1 cent, right? It makes sense. It makes sense. God, there's so much to unpack here that I'll be really curious about. But let's do. I want to. One thing that I thought about is how much of a deal for you is personal relationships, because it sounds like you have to juggle a lot of balls with a lot of people. You have to make everybody happy. And how much is it financial modeling? Because it also sounds like all those different deals for different stakeholders in different seniorities and tier have to be managed and somehow calculated and somehow be like, does this still make sense for us, right? So how much is handling people and how much is handling like the financial modeling and maybe something else that I just completely don't have on the radar?
That's a good question. So I would say the first, as we come into a deal, so if I just think about the first time we're getting into a deal, what we're really trying to understand is, obviously, what is this business? What makes it special? What did they invest in, right? How much capital did they get and where did that capital get invested? And can we see the value? So for example, can we look at the technology and really see something unique about that technology? So the first thing we're doing, and then also we want to understand why isn't it, usually there isn't growth, right? So, or there's minimal growth. So our feeling is, why isn't it growing? Why did the current customers buy the product? Why do they like it? Like just really figuring out, can we add value? If we buy this, is the current revenue base stable? And then can we grow revenue if it's under our management? Do we see something that they didn't see or they didn't try, or, so that's really the first thing you're trying to do is just understand, do we want it? And then if we want it, you very quickly go into, can we get a deal that works for us? And so where we start with that is, so my associate and I will put together a model. We do start with a model, right? A return model of, okay, if we invest, how much capital do we think they need? Where, based on what we know about the current balance sheet, what do we think is going to have to go out the door? Like you can often have a good sense of what's your starting point of the deal, and you model that out and figure out, at what do we think is the exit price? Are we going to hit our returns? So, and then once we do that, that's what delivers out the first term sheet. So we're often putting that term sheet out and we're saying, look, here's the deal that works for us. And then when you start negotiating, everything is a trade, right? They're like, well, you've offered us 20% go forward equity. We want 30%. We're like, okay, well, if you want 30%, then we need 3.5x liquidation preference instead of a 3x or whatever it is, right? So that's kind of the process that you're doing. But the modeling is, you really have to walk in. I've found you have to walk in knowing, what is our baseline deal that's going to work? And then if they say no, like too much negotiating, and we just say, look, we're out. Like, it is a negotiation, but it's not like, we're not going to move, 10 feet. Like, we're going to move like 10 inches. Like this, we can't. So, because
you go a bit to the left, you go a bit to the right, like you have so what I understand is you have your standard. If we buy it at 4 million, we need to make 12 million, because then on average we make a good return for the portfolio. This is some standard fair things that we had in the past, like liquidation preference, right? And then I kind of imagine this, you have like a kind of little value indicator, right? If we decrease our liquidation preference for them, then well, okay, this takes like 300,000 off our exit value, and then in return we need to get something else that gives us those 300,000 back. And then every kind of point, every kind of clause that you can put in there has like some, roughly speaking, some value attached to it. Is that roughly how I can imagine that?
Mm-hmm. Yeah. Everything is a trade, but we make sure that we set. I know there's all this like pricing theory. You don't want to be the first one to throw out a price. We're always the first one, because we're like, we don't care what your price is. So we want to anchor the deal at our baseline. Here's our optimal deal. We anchor it here, and then so that you're not starting. We don't want someone to say, well, actually, I was hoping you'd start at 10 million. I'm like, well, that's never going to happen. So like,
yeah. I mean, I guess it's like we could probably make a whole episode about how to negotiate, but basically, whoever has the best option B, they win the deal, right? If your option B is like, well, like, I'm going to the next company, their option B is like, well, I'm going to make it go bankrupt. So it's a pretty strong position where you can make some mistakes, some classical mistakes in negotiating. Like, don't tell the first price, right? It's like what you think is a mistake, but because your price is based on your research, you're not being greedy. You don't want to underpay or like take too much value. As long as you're fair, right? This is a good starting point.
Correct. Yeah.
Another thing that I wonder is, because many of the decision criteria you mentioned when think about, do we want a deal before even the deal gets to negotiate? Do we want a deal? The decision criteria sounds quite close to what a VC would think about, right? By all the only thing is, I imagine, is like, and if you take a look at the company, you go back to basics, right? Like, many founders should do this regularly. They go back to basics in terms of, what do our customers love? What's the product that we're building? And kind of like, and I feel like, and I've been guilty of this myself as a founder, right? Like, you kind of get lost in the weeds. Like, you get lost in all the opportunities you have, and then you have someone to take you back and like, look, let's like go back to basic. Let's do this from the start again. What are your typical decision criteria for you? And then one very direct question: do you usually look to keep the old management team, the founder team, or do you sometimes or always or never kind of get rid of them?
So I think that has evolved over time. When Dan first started Stage, he was really taking highly distressed companies because he was trying to build a track record. So you didn't get a lot of choice, right? You had to just take. And so in those cases, often the management had either already left, or so he often didn't have a lot of times even the option of keeping the management team. In this fund, like as we've been in market now, more and more, we look to keep the founder. And really what we're saying to that founder is, you were heading down this one path, you were given a blank check and you had to deal with everything. And now by partnering with us, we're actually going to tell you that your job is to focus on product market fit, right? Your focus is really product and sales, and everything else, all the finance, all the HR, all the admin, thinking about payroll, cash management, all of that is going to fall on our shoulders. And so all of a sudden we're now partners in this, and you're more, I think as a founder, like you have to do what you love. Like when I was a founder, all I want to do is sell. I just want to sell and build product. I don't want to.
I was just literally thinking, that sounds good. That sounds amazing. I wish I had that.
Now, look, you give up control, but you get like, there's something really, when you can, again, I think a lot of it comes into like ego, right? If you can not have the ego and you can accept that actually you're going to do well on this and you're going to get to do what you love. It's not going to be written up in TechCrunch, right? Like, then I think it's actually a good deal. So Our goal
And you
is
don't come to that, sorry to interrupt like that, but you don't come to a stage where you buy founders without being actually good at the singular focus a founder should have, and that's product market fit, right? So you don't even get to that stage. So you have to pass the hurdle of, all right, you can actually do a founder thing, which is like finding a product, finding a market, finding product market fit. But then you probably get distracted with like all the things that you get thrown at, and then okay, sorry to interrupt. Please continue.
Yes. What we're trying to find is two things. One, we're looking for product market fit, like a VC. Right now, I'm not as concerned about crazy TAM, like has to be, hundreds and hundreds of billions. Now, I did look at a company the other day that had like $100 million market. And I was like, this TAM is very small. So like, we're not going to go into this, but so balance. And it's really though about, we really want to know if the revenue is sticky. Like once you get a customer, do they stay for a long time? That's a big thing that we're looking for. And then when it comes to the founder, in order to keep the founder has to have they have to demonstrate some like awareness that they understand the mistakes that they made. So sometimes we get to a deal where honestly the culture change of trying to get that founder to just say like, I know that if I had done this differently, I maybe wouldn't be here, and like sort of just ready to own up and do it differently. Sometimes we run into founders who are like, this was all my VC's fault. This was also, so I had nothing to do with it. If only I had had the money, I wouldn't be here. And we often walk from those deals because honestly, those founders are going to be a nightmare to deal with. Right? It just is, it's very hard. When you're doing what we're doing, you have to show up with some amount of, humility and like willingness to admit that maybe you didn't do things right the first time around, which honestly, I didn't do things right the first time around. So, no one's judging here, but you got to own it.
Ready. you have to be coachable, right? If somebody else owns 50 something % of your company, and you're like, no, it's not my fault, right? It's like
exactly.
What isn't on my head is how big is typical like a deal team? Once you purchase the company, you got an agreement with all the stakeholders. How many people do work from your side, from your end, on this particular company? And then I guess a follow-up question is, how many companies do you take on at once? Because it sounds like a lot of work, right? I kind of know how much work it is for a tiny company like mine, how much work this backend process that you just described are, but I can only imagine this must be so much more and so much worse for a bigger company, Series A company.
Yeah, it's a lot. I mean, we're a startup fund, so the answer is we do a lot with very few people, and we give people Christmas off so they can recover and then come back again. Typically on a deal team, so there's two parts of the deal. There's the deal, legal, structuring, core diligence side, and then there's the operational side, because we're acquiring these companies, we're acquiring a majority interest, and often it's structured as an asset purchase. So we have to create a new company, get everyone new offer letters, get benefits set up, get banking set up. So there's this operational component. So the team is split into two. So I tend to run the deal side, and my partner Ingrid tends to run, she really heads up the more operational side. And so two teams. So myself, our associate, and then we sometimes will bring on we often have a couple of MBA interns at any given time that are helping. And then we sometimes bring in a like specialist CFO type that will come and help just get through diligence on that side. And then on the operational side at Stage, we call them our studio team. So we have a CFO, we have accountants that are helping, an HR person that's helping run that operational side. So it's really two teams working side by side. And so every week you have we use an Asana board, like we have a template going, like there's an internal meeting. Each team is having an internal meeting, or having a joint meeting, getting things going, because deals also have to be done quickly. I think the trick to a value strategy is speed. Because honestly, if you're able to say, look, this is my deal and I'll close this in 5 weeks, it's hard to say no to that like that. And so you can't say, oh, and I need 6 months to close this deal. Like, it's just not going to happen. So we have to be able to move quickly. So we closed, our intention with the second fund is to buy like 8 companies next year. And we bought a company in September. We just closed a deal in November, and we're closing another one in early January, and we have one lined up for February. So we are like, the team's tired right now, but it's also fun, and that's how we grow, right? That's how we grow. We have to be willing to just make it happen, get these companies in, and that's also how we build our process. So it's a pretty high velocity deal model in early stage, because otherwise it would take you years at $3 to $5 million per deal, take you way too long to deploy a meaningful amount of capital.
Okay, so but I mean, trying to relate this to myself, honestly, maybe to my listeners, maybe they're smarter than me, but so I always try to relate this to what I know. And like a typical VC, they do like, I don't think a VC fund would be satisfied with only 8 deals, right? They do like 20, 30 deals in their portfolio company. They do the due diligence, they sit on the board, and then they are kind of like out of the operational, right? But so what I hear is you have a core team internally, and kind of whether you find a good deal and whether you buy into a company, or whether you have 8 companies rolling, the same internal team takes care of them. You don't go to like the big 4 consultancies and like, okay, we stuff you now with that. You have your team, you have your own operations, and you're kind of like just outsourcing that to yourself.
Correct. We hire more people the more companies we bring in, and we might work with like a outsourced CFO firm. We have some contract accountants. So we have contractors that we can come in, but yeah, the way I see it is in a way we're kind of a hybrid between VC and private equity. And it's like that in our deals, right? Big private equity firm, if they did 3 deals a year, that would be huge. And so we're doing more deals than a typical private equity firm, but yes, fewer than a VC, because we have to, it's a different diligence mindset when you have to, like, when you're going to own it, and you have to own all those liabilities and know that's really what you're trying to understand. Honestly, the most of diligence is really just knowing where is your risk. Like, what is the risk that you're buying, and are you comfortable with that risk?
Interesting, super interesting. I mean, this is the first time I talk to someone like you that does that. That's why I love doing the podcast, and that's why I probably ask so many stupid questions and just try to wrap my head around, how exactly does it work. And let's switch gears a bit. We mentioned earlier, and I promised we would get back to the market. So how has the recent development in the VC space, that we can't just put it any other way than just the market completely collapsed or just went really into a downward spiral, how has it impacted your business?
So it's really increased deal flow. It's also increased, I would tell you right now, we're able to buy. So we're looking at a company right now that's had $50 million invested that, we're going to get at a discount. So for us, the volume increases, but what that means is that we're able, it's just, you can get more value. So like the amount of value you can extract from really a company that would not, like this company we're looking at, they would not have talked to us a year ago. They had other options. But now, in addition to the venture market being closed, you've also got the M&A markets that are basically closed, right? No one wants to do any strategic deals. So you have all these companies that were like, oh, we'll just soft land into a strategic. Those deals aren't happening. So it's really these founders are being hit from all sides. So I'm only expecting it to get worse, because I think what you've seen a lot of this year is people saying, let's wait and see. And now as we come into 23, I predict it's going to be not let's wait and see. It's going to be like, no, we don't have the dry powder for you. No, I know VCs are sitting on billions of dry powder, but do all those LPs want them to start calling that capital? I don't think so, right? So like it's one thing to have dry powder. It's another thing to actually call it and start investing it when all the LPs are very nervous and they're seeing their overall portfolios going down. So I have a degree in economics. So I find economic changes very, interesting. And I think this next year is, I'm very curious to see how things shake out. But yeah. I think people think it's going to be like COVID, where it's another kind of V. And I don't think it's going to be a V. I think we're going to be seeing a real shift. And venture has to come back, right? They've got to go back and invest. It's going to look different. And I think it's going to be more focused on the early stage, and those middle ground Series A, B, C companies. Those are the companies that are really going to struggle to raise more capital. The barrier to getting any kind of capital there is going to be higher.
I fully agree. I mean, I don't know how it is in the US, but in Europe, I feel like every other month there's a new super pre-seed seed VC fund of record size announced, right? It's a lot of pre-seed seed VCs that are now closing new deals, and I guess they have to deploy. But I'm glad you answered my question about dry powder, because I would have exactly kind of tried to push a bit against what you said. It was like, why do you think it's going to turn down if we have so much dry powder? But I like the explanation. Well, yeah, there's theoretical dry powder, but as long as the LPs are not called, it's just that theoretical dry powder, right? And to kind of try to soon bring it to a close, our listeners are just interested, interested young professionals, interested students. Maybe they heard from this conversation, oh, God damn it, maybe VC is currently not a great place to start my career, to change my career to. Maybe some founders listening was like, okay, I was hoping to, be an angel investor after my multi-million-dollar exit. And they all say, okay, Krista, how do I get into early stage private equity? Like, this is, maybe we can kind of see where can people get in on this. And no, I'm partly joking. In reality, I'm really interested. What are kind of the skills that you think one should develop to be successful in your field?
So it's been interesting I was a fintech founder, and now I'm a partner at a private equity firm. So I have no background in private equity. When I talk to other private equity people, I feel like we don't necessarily speak the same language. And I think the key to being early stage is, it really is a hybrid model. You have to have a mindset of at least growth. Right? Like, if we just buy companies very cheap, but they don't grow, they don't really gain any value. That isn't a good strategy. So you have to have this growth mindset, but then you also have to have a mindset of, cost efficiency, deal. You have to like deal structure. You have to kind of constantly be thinking about your downside management and, how. So for me, when we talk to people that come in, the people that we find are the best at this are people that have been in an operating role, either as a founder or in an early stage startup. And they've seen, because growing a company from 0 to 10 million is a very different skill set from 10 to 20 and 20 plus. So I think in this early stage model, if you haven't worked in a company, it's hard. It's just hard because you just don't know the realities of what it's like to be on the ground. And so it's harder to give advice to founders. Like I'm able to now, Ingrid and I laugh, we're both founders. We laugh about this a lot where, now we look at things like, oh yeah, this is easy. Just do this. And when we were founders, we didn't know, because you said this earlier, right? Like you're so in the weeds, you're so close to it that it's really hard to have any perspective. And so it's hard to give someone perspective if you haven't been where they are. So I for us anyway, I think that that's something we really look for. Not to say there aren't room for people that are great financial modelers. Like, my associate did not come out of a startup, right? He worked in corporate. He has an MBA finance. He's doing a CFA. So he's great. But it's taking him, he and I work great on the deal side. I think it's taking him really getting to a place where he can actually coach a CEO. That's going to take a lot longer because he just has to see more, right? He has to be around for longer.
So like to kind of summarize how what I took away is the soft skills, which are the more important ones, right? This is the one you have to be a founder. You have to been in the trenches, right? You have to actually seen it. Otherwise, you can't relate. Like I think the things you go through as a founder, like if you have not been a founder, like people just don't understand, no matter who it is. But the hard skills that you mentioned, financial modeling, kind of CFA charter holder, those things, I mean, those are hard skills, right? You can learn them. You can learn how to do an Excel model. You can maybe even learn how to negotiate, but the sort of empathy you feel for somebody else doing that, and maybe even being coachable, saying, oh, damn, I did so many things wrong. If I had somebody, like if even me knowing this, I should have known this, but then you take a step, I was like, oh, God damn it. If if founder to founder, one founder coaches the other, it's like, look, you should do this. Another founder, like, oh, yeah. And like, I think this is really the soft skill where only or nearly only experience can teach you.
I think so. I think so. And, so I don't know if that's a great answer because people have to go through the trenches before they can get in. But here's what I do think is I think this category is going to grow because I think we've seen a lot of money, more venture dollars in 2021 than double the amount of early stage venture dollars than in 2020 and over 2019. So all that money, all that investment, I think the worst thing that could happen is that it all gets wasted and all those companies go to zero. There are going to be more people coming in and saying, let's create that money has value. Let's retain that value versus just letting it waste away. Why would we do that?
Agree. I literally thought the same thing while we explained it. It's like, there's like a socket between like zero and like getting those, like, I don't know, just to stay in the 100 euro or dollar metaphor. Like if it would be a penny, then nobody would go for it, right? But like maybe we get recover $20, 20% of the value that has been before created, or even 100% of the value, which is like, don't exit it to unicorns. And I love this. I love our conversation. Krista, I want to be respectful of your time. You said you don't even have time for intro calls anymore. So I really appreciate you spending the last hour with me and introducing my listeners and me to early stage private equity. If you have anything that you want to kind of get out there, get to our audience, this is the time.
I love to hear from people. So I love to hear from people, and I'm on LinkedIn and pretty active. So please, feel free, and if you see a deal, send it to me. There you go. That's always good. Or if you're thinking about a deal, I'll give you my opinion.
Awesome. I'll link to your profile, to Stage Fund website, and everything in the show notes. And without that, Krista, thank you so much. It's been amazing, and you have a lovely day.
Thank you. Thank you for having me.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Hey again, this is Andy. I hope you enjoyed the episode. If you did, please leave us a 5-star review on Apple Podcasts or wherever you get your podcasts from. Share the episode with your friends, with your colleagues, and everybody that is interested. And if you want to reach out, feel free to drop us an email, a message on social media. And I look forward to hearing your thoughts, your comments, your feedback. And thanks again for listening. Have a great day.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.